US markets hit all-time highs again last week as some bumper earnings from the so-called Magnificent Seven. But whilst AI seems to be propping up the markets for now, we've also got a rumbling of $120 a barrel of oil, as well as a 6% inflation warning from the Bank of England. So is the AI hype something to be worried about, or is it enough to protect your portfolio from a potential downturn? Hi, I'm Zoe. This is my channel, Words on Wealth. As a former wealth manager, I like to break down some of the major headlines, delivering videos on a Monday and a Friday with no jargon and no fluff. Do make sure that you like, subscribe, and turn your notifications on if you're enjoying these videos. First up, let's talk about that so-called Magnificent Seven. They are currently in charge of driving most of the gains of the S&P 500, not least of which because they make up most of the weight of the S&P 500. Now, what we've seen over the last few weeks is a flurry of earnings reports from these so-called Magnificent Seven and many other companies as well. And what really seems to be hinging whether they do well or not is off the back of how well they're harnessing and look like they're forecasting their relationship with AI. What we've seen with Apple is that actually their fantastic relationship with their latest iPhone is what has driven their gains. And they're taking a slightly funny approach to AI. In fact, it's more of a step back. What they're seeing is that actually they are not necessarily backing one AI horse or bringing it in-house, whilst others, like Meta, have really backed an AI horse, but are not being seen quite so favourably with investors at the moment due to the fact that actually they're perhaps overspending and not necessarily yet seeing quite what that's going to reap in future with profits and returns for those investors. So what does this mean for you and your investments? Because this talk of an AI bubble, it's been around for ages and it's still causing fear amongst most investors. Is it going to suddenly pop? Are we going to see all of our valuations go down? What does this actually mean? Well, what I think we're starting to see more than ever is that investors are looking more and more for returns, and they want to know that they're not just backing thin air, quite frankly, but also something else behind it. It may well explain why Apple has done so well, because the iPhone is still a tangible thing. So what we're seeing is that actually investors are shifting into a mentality of wanting to know what AI is giving in returns rather than just the hope of what it could bring. So when we're looking at your portfolio, what this really means is that there may well be a bit of a slowing as that mentality starts to kick in and investors do start to adjust to not just hope, but also reality. It may not mean that there's going to be a big burst, but it might mean that we will not see quite the levels of growth that we have done over the last few months, years when it comes to AI. On to the economic news of the week, which may well sting our pockets a little bit more than we want. Oil hit $120 per barrel, which means that once again oil is back up above where most governments want it and is frightfully pushing us towards inflation once again. Whilst you and I aren't paying for oil by the barrel, this price point is much higher than it has been previously, and what it also shows is that everything is going to get more expensive. And all of that has been caused by the fact that Donald Trump had said that the blockage of the Strait of Hormuz could last for months. This is already being shown in figures, with the inflation figures out last week for the US and the personal consumption index up to 2.5%, and across the Eurozone, inflation creeping up to 3%. In reality, both of these places want a 2% max of inflation. We want a little bit, but not too much. This oil news, combined with the news around inflation and the ongoing uncertainty in the Middle East, led the Fed, the central bank in the US, the Bank of England here in the UK, and the European Central Bank to all pause their interest rates. We have been seeing that they have been coming back down again because inflation has started to come back down from when we saw the inflation levels peak to around 10% a few years ago off the back of the conflict in Ukraine. Now, for those who are on variable mortgages or looking to get a mortgage, interest rates coming down is really quite appealing because borrowing gets cheaper and therefore those things get easier. Equally, often when interest rates are lower, it usually means that the economy is able to stimulate more because people are able to borrow more to be able to spend more. What it means for people who are holding money in cash, though, is that those interest rates are likely to stay more or less the same. Nonetheless, whilst those interest rates have been held firm, they're still likely to be below what inflation is at. And what that means is if you're holding excess money in cash, it's still not good news. It's still not going up, right now at least, And that means that when we're looking at holding money in cash versus investing, still usually on average over time, those investing figures are winning. This is only echoed by the warning given this week by the European Central Bank and the Bank of England that inflation could hit up to 6%. This is frightfully higher than the 2% that we're wanting, and we'll really feel it once again in our pockets, our spending, and within those savings if they're held in cash. So what does all this economic news mean then for you, your money, and your investments? What it means is we're entering a period once again where inflation is potentially on the horizon. That is to say that prices may generally start to go up again. We might also start to see interest rates at the very least remain where they are, if not potentially come up once again, as and when inflation also goes up. What that could mean is those that are currently on mortgages may want to lock in as soon as possible before anything like that kicks off. Equally, those who have got money in cash may well be looking to move it more into investing-based options if possible and if in line with your risk profile. As for the prices rising, unfortunately, there's not a lot we can do about that, but to just simply watch and try and keep abreast of what is going on. And on to my two final tales of what seemingly are doing well and not doing well in the stock market world. Firstly, US defence companies and European defence companies have actually seen their valuations come down since the beginning of the conflict in the Middle East. This might sound somewhat counterintuitive, because surely in a period of conflict we're going to need more defence. But it's not that simple. What it really shows is that actually just because there is increased conflict, it does not yet mean that there is increased government spending, because normally presidents, governments have to pass certain laws to be able to increase their budgets. And what this really means is that there's a lag and a delay. So it's not necessarily just about demand, it's also about capacity. And if those defence companies can't immediately produce the capacity, which of course they can't, and if governments can't immediately pay them, which of course they can't, then we don't necessarily see a huge uptick. And whilst there's ongoing uncertainty within the world in general, what we're seeing is that actually those defence companies and their stock valuations aren't quite behaving as we might expect. On the flip side, we saw Eli Lilly, the pharmaceutical company, see their revenue soar by 56% in just the first quarter. This is all off the back of their GLP-1, aka their weight loss injection drugs, doing super well. It's a classic example of a horse race where one company finds a product that's doing really, really well and is becoming really popular, and as a result they pull away from other competitors, and we start to see a theme emerge and quite a lot of hype from investors. It may well be that these weight loss drugs do remain to stand something that is really the future. Equally, we might start to see the short-termism kick in. Can they really last forever? Will that hype really remain? Or will there start to be a pivot away from them in future? Who knows? But if pharmaceuticals is an area that you're watching within your portfolio, it's certainly one to have honed in on the last week. So there you have it, some of the major headlines from the last week and what they mean for you and your investments. Do make sure that you're liking and subscribing if you're enjoying these, and of course, if you see any headlines that you want breaking down, drop them in the comments and I'll do my best to weave them in for next week. Have a good one and see you then.